Buyer power just flipped the American housing market upside down. For the first time in over a decade, discounts are crushing list prices, bidding wars have evaporated, and sellers are scrambling to move inventory. In 2025, the typical home buyer who negotiated below list price scored a 7.9% discount, the largest since 2012. That is not a minor dip. That is a full market reversal. Nearly two-thirds of all buyers paid less than asking price last year, the highest share since 2019. According to Redfin analysis of MLS data, 1 in 4 buyers who scored discounts got 10% or more slashed off the list price, a phenomenon not seen in 13 years. The pandemic seller's market is officially dead. Buyers now hold the cards, the negotiating power, and the ability to walk away. This is the strongest buyer's market in recent history, and if you're hunting for a home in 2026, understanding this shift could save you tens of thousands of dollars. Hit subscribe to Housing Intel for data-driven real estate intelligence you won't find anywhere else. The collapse of the seller's market didn't happen overnight. It's the result of a brutal collision between affordability crisis, mortgage rate shock, and a supply surge that sellers weren't prepared for. Between 2020 and 2022, sellers dominated. Homes sold in days. Bidding wars were standard. Buyers waived inspections, paid cash over asking, and begged for acceptance. But 2025 told a completely different story. There are now 47% more home sellers than buyers, giving the shrinking pool of active buyers unprecedented leverage. Demand has retreated due to mortgage rates hovering above 7% and home prices still near all-time highs. Meanwhile, many sellers are stuck in a pandemic mindset, pricing their homes based on what their neighbor's house sold for in 2021. That strategy is backfiring catastrophically. Listings are sitting longer, price cuts are becoming the norm, and desperation is creeping into negotiations. Some sellers who bought at the peak are facing a harsh reality. They paid top dollar and now can't sell for top dollar without ending up underwater. The numbers paint a brutal picture of this power shift. In 2025, 62.2% of all homebuyers paid less than the list price. Compare that to just 22.8% who paid more than asking, the lowest share since 2019. Only 15.6% paid exactly the list price, a figure that has remained relatively steady. For buyers who successfully negotiated discounts, the typical savings amounted to $31,592, calculated by applying the 7.9% average discount to last year's median original list price of $399,900. Even among all buyers, not just those who negotiated below asking, the average discount reached $15,196, or 3.8%. These are not symbolic concessions. These are substantial financial victories that directly impact affordability and equity building. The shift is even more dramatic when examining deep discounts. Roughly one quarter, 26.1%, of homebuyers who paid below list price in 2025 secured discounts of 10% or more, the highest share since 2012. Another 27.8% scored discounts between 5 and 10%, the highest share since 2013. The lion's share, 46.1%, received discounts in the 0 to 5% range, actually the lowest share in that category since 2012. What this reveals is a bifurcated market where aggressive negotiations are yielding outsized results for savvy buyers. Sellers who refuse to adjust to the new reality are getting punished with deeper cuts, longer days on market, and in some cases, delisting entirely to wait for better conditions that may never arrive. Why are sellers struggling so much to adapt? The answer lies in psychology and financial constraint. A significant portion of current sellers locked in mortgage rates between 2 and 3% during the pandemic. They're only willing to sell if they can extract enough profit to cover the higher monthly payment on their next home, which would carry a 7% rate. This creates a pricing floor that often doesn't align with what buyers can afford or what comps support. As one Dallas agent noted, some sellers want to list homes at $950,000 when recent comps call for $825,000. That gap is where deals go to die. On the flip side, sellers who price aggressively and realistically are still seeing multiple offers and even modest premiums. A home priced at $385,000 when the seller paid $400,000 can generate competition precisely because it's priced for the current market, not nostalgia for the pandemic boom. The inventory surge has fundamentally altered market dynamics. Homes that once moved in 72 hours now sit for 70, 80, even 90 days. Sellers are cutting prices not once, but multiple times, chasing a moving target of buyer demand that keeps softening. According to market analysts, pricing has become increasingly difficult because conditions are shifting rapidly and varying wildly by location. Some areas maintain strong demand, but many others are experiencing fast deterioration. This unpredictability forces sellers into reactive mode, slashing prices after initial listings fail to generate interest. For buyers, this creates opportunity. Patience pays. Lowball offers get countered instead of rejected. Contingencies are back on the table. The power dynamic has completely inverted. Property type matters enormously in this discount environment. Condos are getting hammered the hardest. The typical condo buyer who paid below list price in 2025 secured an 8.1% discount compared to 7.9% for single-family homes and 6.5% for townhouses. This marks the first year since 2014 when condos sold at a bigger discount than single-family homes. The reason? A perfect storm of rising HOA fees, soaring insurance costs, and in some markets, hefty special assessments. Condo associations dealing with deferred maintenance or new regulations are passing costs to owners, making monthly carrying costs unsustainable. Among all condo buyers, the average discount hit 4.8% versus 3.7% for single-family and 3% for townhouses. Overall, 68.1% of condo buyers paid less than list price, compared to 61.7% for single-family and 60.4% for townhouses. Geography reveals even starker contrasts. West Palm Beach, Florida leads the nation with the deepest discounts. The typical buyer who paid less than list price in West Palm Beach scored a 10.9% discount, the largest among the 50 most populous metros. Detroit follows at 10.3%, then Fort Lauderdale at 10.3%, Pittsburgh at 9.9%, and Miami at 9.8%. Florida dominates the discount leaderboard for specific reasons. The state builds more homes than any state except Texas, flooding the market with inventory and giving buyers abundant choice. But Florida also faces intensifying hurricanes, insurance premiums that have surged over 60% since 2022, and condo HOA fees spiraling out of control due to new structural safety regulations post-Surfside. These factors combine to force sellers into offering concessions just to find willing buyers. On the opposite end, Seattle posted the smallest discounts among major metros. The typical buyer who paid below list price in Seattle got just a 5.7% discount. Washington, D.C., Minneapolis, Las Vegas, and Virginia Beach all hovered near 5.8 to 5.9%. These markets maintain tighter supply-demand balance, stronger local economies, or demographic tailwinds that keep prices relatively sticky. Interestingly, there are only 4 metros where the typical homebuyer still paid more than asking price in 2025. San Francisco leads with a 3.8% premium, followed by Newark at 3.1%, San Jose at 2.3%, and Oakland at 1.3%. The Bay Area housing market has heated up recently due to the AI boom and return-to-office mandates from major tech companies. It's also worth noting that Bay Area sellers have historically underpriced homes intentionally to create bidding wars, though even this premium is shrinking compared to prior years. The implications for 2026 buyers are profound. Home buyers should not write off properties slightly above their budget, because there's a legitimate chance they'll secure price cuts, closing cost credits, or repair funds from sellers. This is a complete reversal from pandemic advice, when buyers were told to search below budget to accommodate inevitable bidding wars. Now the strategy flips. Target the upper range of affordability, negotiate hard, and expect concessions. Sellers are motivated. Inventory is high. Mortgage rates remain elevated, keeping competition low. For buyers with financing locked and flexibility on timing, this is the most favorable negotiating environment in over a decade. Sellers, meanwhile, face tough choices: overprice and watch the listing go stale, price aggressively and risk leaving money on the table. The sweet spot is pricing at or slightly below recent comps to generate early activity and potentially multiple offers. Days on market matter immensely in this environment. Fresh listings attract attention. Stale listings signal desperation. Sellers must also be prepared to offer concessions beyond price. including covering buyer closing costs, offering rate buydowns, or funding repairs identified in inspections. The era of as-is cash offers 20% over asking is over. Sellers who adapt survive. Those who don't end up delisting or taking losses. This discount phenomenon also signals deeper structural shifts in housing affordability. While discounts are rising, they're still below pre-pandemic levels in some categories. The share of buyers paying premiums, though falling, remains above historical norms. This suggests sellers are still anchoring prices at the edge of what buyers can afford, causing most homes to sell below list price again, but not collapsing into fire sale territory. The market is normalizing, not crashing. Prices aren't plummeting nationally. They're adjusting downward in overheated markets while stabilizing in balanced ones. This creates a patchwork landscape where location, property type, and individual seller motivation matter more than ever. For investors, this environment demands precision. Markets with deep discounts like West Palm Beach, Detroit, and Fort Lauderdale may offer entry points, but they also carry elevated risks around insurance, climate exposure, and economic volatility. Conversely, markets with minimal discounts like Seattle and DC offer stability but limited upside in the near term. The play for sophisticated investors is identifying markets where discounts are widening, inventory is rising, but fundamentals remain strong, such as job growth, population inflows, and infrastructure investment. Those markets will recover fastest when rates eventually decline. The message is undeniable. 2025 marked a definitive turning point in the U.S. housing market. Buyers reclaimed negotiating power. Discounts hit 13-year highs. Sellers lost pricing control. And the dynamics that defined the pandemic era, scarcity, urgency, premiums, have been replaced by abundance, patience, and concessions. For anyone entering the housing market in 2026, understanding this shift is not optional. It's the difference between overpaying by tens of thousands or securing a deal that builds wealth from day one. Armed with this data, you can avoid overpriced listings, negotiate aggressively, and position yourself strategically. Knowledge is protection in a volatile market. If this breakdown opened your eyes to the power shift happening right now, smash that like button. Subscribe to Housing Intel for weekly real estate intelligence that cuts through the hype and delivers actionable insights. Drop a comment below and tell us which market shocked you the most. Are you buying, selling, or waiting on the sidelines? We read every single comment. We'll see you in the next video, because in this market, knowing when and how to negotiate can be the best investment decision you ever make.